Thank you for clicking on this video to learn about the Federal Reserve Bank. Have you ever pondered upon the way the Federal Reserve Bank impacts the stock market? Now we're going to delve deep into that. The Federal Reserve Bank, typically known as the Fed, is the central bank of the United States. Tracing back its establishment to the year 1913, it plays a monumental role in the U.S. economy. The Fed is entrusted with the implementation of the country's monetary policy, encompassing management of money supply and interest rates. These monetary policies have a profound influence on economic activities, including the stock market. When the Fed tinkers with interest rates, it can either stimulate spending and investment or induce saving. The ripple effects of these actions reverberate through the entire economy, reaching from Wall Street to Main Street. The Fed also oversees and regulates banks, ensuring their operation in a safe and sound manner and catering to the needs of thus. The Federal Reserve plays a pivotal role in the financial stability of the U.S. One of the tools the Federal Reserve uses is the discount rate. But what is it exactly? Well, the discount rate is essentially the interest rate charged by the Federal Reserve to commercial banks and other depository institutions on loans they receive from their regional Federal Reserve Bank's discount window. Think of it as the Federal Reserve's lending rate to banks. Now, why is this important? Because it's a key tool the Fed uses to help manage the supply of available funds, which in turn influences inflation and other interest rates. Let's dig a little deeper. When the discount rate is high, it's more expensive for banks to borrow from the Federal Reserve. As a result, banks are more likely to lend to each other instead of relying on the Fed. This can lead to an increase in the federal funds rate, which is the interest rate banks charge each other for short-term loans. On the other hand, if the discount rate is low, borrowing from the Federal Reserve becomes more attractive to banks. This can lead to a decrease in the federal funds rate, making it cheaper for banks to lend to each other. Now you might be wondering, how does this affect me? Well, changes in the discount rate can indirectly influence the rates you see on various types of loans and savings. For instance, if the discount rate increases, it could lead to higher interest rates on things like mortgages and car loans. Similarly, if the discount rate decreases, those interest rates might go down. But it's not just about borrowing. The discount rate can also affect the interest rates on savings accounts. When the discount rate is high, banks may offer higher interest rates to attract more deposits, which they can then lend out. Conversely, when the discount rate is low, banks may lower the interest rates on savings accounts. Therefore, the discount rate can impact your mortgage, car loan, or even your savings account interest. So understanding this tool of the Federal Reserve gives us a clearer picture of how the economy operates and how our personal finances can be affected. Another key responsibility of the Federal Reserve is controlling inflation. But how does it do that? Well, for starters, it uses a tool called monetary policy. This policy is all about controlling the money supply, the total amount of money in circulation in the country. We can think of the money supply as the lifeblood of the economy. If there's too much of it, the economy can overheat, leading to inflation. But if there's too little, the economy can grind to a halt, causing unemployment and economic stagnation. So how does the Federal Reserve control the money supply? One way is through open market operations. This involves the buying and selling of government securities, like treasury bonds. When the Federal Reserve buys these securities, it increases the money supply because it's essentially pumping money into the economy. Conversely, when it sells these securities, it decreases the money supply, pulling money out of the economy. Another way the Federal Reserve controls inflation is by manipulating interest rates. Specifically, it adjusts the federal funds rate, which is the interest rate at which banks lend money to each other overnight. If the Federal Reserve wants to curb inflation, it can raise this rate. Why? Because when borrowing money becomes more expensive, people and businesses are less likely to take out loans. This slows down economic activity and, in turn, inflation. But it's not just about preventing inflation from getting too high. The Federal Reserve also has a mandate to keep inflation from falling too low. That's because when inflation is too low or even negative, a situation called deflation, it can discourage spending and investment, leading to a sluggish economy. To strike the right balance, the Federal Reserve aims to keep inflation within a target range, typically around 2%. This target is seen as a sweet spot that allows the economy to grow without overheating. So, the Federal Reserve's actions can directly influence the prices you pay at the store. That's right. By controlling inflation, the Federal Reserve plays a crucial role in maintaining the purchasing power of your dollar. The Federal Reserve also has a goal for unemployment. But what is this target and why does it matter? The unemployment target is a component of the Federal Reserve's dual mandate, which includes both price stability and maximum sustainable employment. This target isn't a specific number, but rather a range that reflects what economists call the natural rate of unemployment. This is the level of unemployment that an economy can sustain without triggering inflation. Now let's dive into this a bit deeper. The natural rate of unemployment is the sum of structural and frictional unemployment. Structural unemployment occurs when there's a mismatch between the skills workers possess and the skills employers need. Frictional unemployment, on the other hand, refers to the short-term joblessness that occurs when people are between jobs or are entering the labor market for the first time. The Federal Reserve doesn't have a fixed numerical target for the unemployment rate because it's affected by a multitude of factors, many of which are beyond the control of monetary policy. However, it does use its monetary tools to strive for maximum employment, which is a level of employment where additional increases would start to push up inflation. Now, how does the Federal Reserve strive to achieve this target? It uses monetary policy. By adjusting the federal funds rate, it can influence overall economic activity, including employment levels. For instance, if unemployment is high, the Federal Reserve might lower the federal funds rate to stimulate economic growth and job creation. Conversely, if the economy is overheating and causing inflation, the Federal Reserve might raise the federal funds rate to cool down the economy and prevent an unhealthy rise in prices. Therefore, the Federal Reserve's actions can affect whether people can find jobs. These actions, guided by targets and economic indicators, are a testament to the Federal Reserve's commitment to fostering a healthy and stable economy. You may have heard of the FOMC meetings, but what happens in these meetings? The FOMC, or Federal Open Market Committee, is the branch of the Federal Reserve Bank that is responsible for making key decisions about interest rates and the growth of the United States money supply. The committee consists of 12 members. 7 of these are the members of the Board of Governors of the Federal Reserve System, and the remaining 5 are Federal Reserve Bank presidents. One of these 5 is the president of the Federal Reserve Bank of New York, who is a permanent member, while the other 4 are elected from the remaining 11 reserve banks on a rotating basis. One of the main roles of the FOMC is to set the target for the federal funds rate, which is the interest rate at which banks lend each other money overnight. This rate influences all other interest rates in the economy, making it a powerful tool in the Federal Reserve's arsenal. The FOMC typically meets 8 times a year in Washington, D.C., although additional meetings can be scheduled if needed. During these meetings, the committee reviews economic and financial conditions, determines the appropriate stance of monetary policy, and assesses the risks to its long-run goals of price stability and sustainable economic growth. Decisions made in these meetings can have a profound effect on the economy. For instance, lowering the target federal funds rate can stimulate economic growth by making it cheaper for businesses and consumers to borrow money. On the other hand, raising the rate can slow inflation by making borrowing more expensive. It's worth mentioning that the outcomes of these meetings are closely watched by investors around the world. Any hints of changes in monetary policy can cause stock prices to swing as investors try to anticipate the effects on the economy. So the outcomes of these meetings can have a significant impact on the economy and your wallet. We've covered a lot about the Federal Reserve Bank. Let's recap. The Federal Reserve Bank, or the Fed, plays a pivotal role in the U.S. economy. It's the central bank tasked with managing our country's monetary policy. One of the tools it uses is the discount rate, the interest rate charged to commercial banks and other depository institutions on loans. By adjusting this rate, the Fed can influence borrowing costs and consequently, spending and investment. In addition, the Fed has a responsibility to control inflation, which it does by manipulating interest rates. It also aims for a specific unemployment target, typically around 4 to 5%, balancing job creation with inflation control. The Fed's key decisions are made during the Federal Open Market Committee, or FOMC meetings, which occur 8 times a year. Understanding the Federal Reserve Bank can help you make sense of economic news and make informed financial decisions. Before we wrap up this informative journey about the Federal Reserve Bank, we want to remind you that your support means a lot to us. If you found this video helpful and want to keep up with more content like this, please hit that like button. It helps us reach more people just like you, who are hungry for knowledge. And don't forget to subscribe to our channel and click the bell icon so you never miss an update from us. We regularly release videos on various economic and financial topics. Join our community of knowledge seekers and let's learn together. Remember, your curiosity fuels our creativity. Until next time, keep learning.